G'day and welcome to the Firetrail Analyst Series, where we take a deep dive into a stock or sector with one of Firetrail's key analysts and really focus in on what matters for that business. Today with us, we've got Ramoun Lazar, who's covered industrials for over 15 years. Ramoun, thanks for joining us.
Thanks, Carl.
Now, the brief today was to cover an inexpensive defensive to invest in through this current market environment. What have you got for us today?
The stock that we really like in this environment is Amcor. Amcor, we think, is an inexpensive defensive. If you think about Amcor, it's one of the world's largest packaging companies. So it produces plastic packaging in the consumer space, for medical companies, for pharma companies. It's got a great range of companies. Its key customers, companies like Nestle, Unilever, Pepsi. And then if you dig deeper and look at some of the products that it manufactures, you're thinking about products like stand-up yogurt pouches, protective barrier films for meat and fresh produce. And then if you look at, I guess, all the end markets put together, we think 80 to 85% of Amcor's end markets are highly defensive, so grow with consumer trends. And if you look at Amcor's geographic diversification, about 70% of its revenues come from Europe, the US, and other developed markets such as Australia, and then 30% comes from more emerging markets where we think longer term will provide higher growth rates.
Can you run us through a bit about the competitive environment, where Amcor sits in terms of its position in the market, and who are some of those key customers it's serving?
If you think about Amcor's end markets, Western Europe, the US are the largest. In both those markets, it's now the number one player. So it's been the number one player in Western Europe for a long time, Eastern Europe alongside that. And then in the US, a couple of years ago, it bought the largest player, Bemis.
Okay.
So that made it a global offering to large global FMCG companies. Again, companies like Nestle, Unilever, Pepsi, Kraft, all these companies Amcor has as its key customers. If you think about the model, if you think about the Amcor model, it's a pretty simple model. So the demand for its products grow by population growth, maybe a bit more, a bit less. So volumes tend to grow 1%, maybe 2%. Delivering that volume, Amcor will produce bottom line growth, so EPS growth of something in the order of 3%. Now, the key attractiveness of that is that it's a highly cash flow generative business. So, 3% bottom line growth will deliver the business about $1.5 billion of cash flow.
Yes.
Of that, it needs to reinvest about $500 million to continue to deliver 1% to 2% volume growth. Now, that leaves us with $1 billion of free cash flow. So what does it do with that $1 billion? It gives back to shareholders in the form of dividends. So about $700 million of annual cash flows go back to shareholders as dividends. And if you look at the business, it has a very attractive yield. It's currently yielding about 5%.
Wow. Which
is very good in this sort of market environment. It's also one of the companies that hasn't deferred dividends or cancelled dividends given what's going on with coronavirus, etc. Then after those dividends, you've still got $300 or $400 million of free cash flow left. So what does it do with that $300 or $400 million? It can take that and return it to shareholders in the form of buybacks or other capital management initiatives, or undertake further M&A. So historically, the business has grown because it is a mature industry. The way that its Amcor has grown is through M&A. So the end markets continue to be fragmented. Plastic packaging or flexibles packaging, which is what Amcor dominates, is a highly fragmented industry. So there continues to be acquisition opportunities. At the moment, we think that they're probably sidelined because the business is in the middle of integrating and delivering on Bemis.
And Ramoun, when we talk about companies and when we run through them in our investment committees, we always focus in on what matters. And the last investment committee you presented Amcor on, you were talking about this new Bemis acquisition and really how that's going to drive future growth and drive synergies for Amcor. Can you run us through that part of the investment thesis?
Amcor acquired Bemis in 2018. It was quite a large acquisition. Like you can see from the slide there, Amcor's flexible business prior to Bemis had roughly 5 billion of revenues. Bemis had about 4 billion of revenue, so pretty similar in terms of size. What it gave Amcor though was a number one position in the North American market, so particularly in the US market, where Bemis was a clear leader in flexible packaging. Now, putting all that together, Amcor now has a global footprint in flexible packaging, whereas previously it didn't have that North American exposure. So it's now the number one player in Europe, North America, Latin America, and the Asia Pacific. What that enables the business to do is take that offering to your global brands such as Nestle or other major FMCG companies, Unilever, Kraft, and then Pepsi, etc., and offer them a one-stop shop effectively for their packaging products on a regional basis. The second major driver of the acquisition is synergies. So Amcor has stated that it expects to deliver about 180 million of synergies through the Bemis acquisition. All those synergies are cost-based synergies, so there's no revenue-based synergies assumed within that 180 million. We think over time, as the business is integrated into the Amcor fold, there will be opportunities to drive revenue synergies. So, if you're doing a piece of work for Pepsi in Europe, you're not doing it in the US, there's that potential to go to them in the US and say, well, we're providing you this service in Europe, we can do that in the US, and Pepsi knows Amcor well from other regions, and is more likely Amcor is more likely to get an audience to try and win that business. So we think that's a longer term potential that Bemis provides.
I suppose, Ramoun, when we think about the packaging industry and in particular plastics and single-use plastics, it can be a bit controversial in terms of the sustainability of single-use plastics. Is this going to be an issue for Amcor over the long term, and how are they addressing these sustainability issues?
Yeah, so I look at sustainability with regard to Amcor in three ways. The first wave is single-use plastics are definitely on the way out, or they're going to be significantly reduced over time. Now, when we talk about single-use plastics, we're talking about things like plastic shopping bags, garbage bags, disposable cutlery, for example. These are highly commoditized, low-value products. Amcor doesn't do any of those.
Okay.
So that's the first thing. The second thing is, are plastics going to continue to be used over time? And we definitely think that plastics have a place in society and in how consumers behave or interact with products. So for example, if you look at companies like Coke and Pepsi, both have committed to the ongoing use of rigid plastic containers or PET containers. Why is that? Because they're 100% recyclable, they have a much lower greenhouse gas footprint than the alternatives, which are really glass and aluminium cans.
Okay.
So we think those type of plastics, alongside high barrier films for meat and fresh produce, definitely have a place in society. And then the third approach is how can Amcor help its customers deliver on those sustainability goals? If you look at the slide, you can see some of Amcor's key customers, what their promises are or objectives are around sustainability, reuse, recyclability through 2025. And some of these are pretty ambitious goals. And companies like Unilever, Nestle, Pepsi, Coke have all gone out with significant targets. Now, we think it's going to take a company like Amcor, a global leader in developing some of these products, in enabling some of those large global FMCG brands to deliver on some of these goals.
How do you think about valuing a defensive company like Amcor?
Yeah, so as an Australian investor, obviously we comp Amcor against other defensive Australian businesses.
Yes.
So putting aside its highly attractive cash flow metrics, and which enable a pretty attractive dividend yield, for example, that 5% dividend yield as I mentioned previously. If I compare it to companies that are in the same sort of space, I'm thinking about companies like Woolworths, Wesfarmers, Coles, Brambles, Coke. Now, if I think about Woolworths and Wesfarmers, those companies are trading on 25 times, 1 year forward PEs. Coles, Brambles are trading on 20, 21 times 1 year forward PEs. If I think about Amcor, it's trading on 14 times.
Wow.
So it's trading at a significant discount to those businesses and is also still generating a 5% dividend yield. And I think that in the context of risk reward looks pretty attractive.
For sure. Ramoun, thanks for joining us today to provide your inexpensive defensive idea. And thank you for joining us for the Firetrail Analyst Series.